and welcome back to the Rock and Turner Investment Podcast. We're excited to have you join us for another episode filled with valuable insights and expert analysis to help shape all of your investment decisions.
It is a great pleasure to welcome to Best Ideas 2025 James Emanuel, founder of Rock and Turner Investment Partnership. James is also the author of an excellent Substack to which I would encourage all of our listeners and members to subscribe as well. James lives and works in London, is happily married with 3 children. He qualified in English law, having achieved a Bachelor of Laws degree with honors. He subsequently secured a postgraduate legal practice certificate from the Law Society of England and Wales. However, having enjoyed the academic side of law, practicing law was not what excited him. Sharing a family aptitude for mathematics and economics, he was drawn into the world of finance, particularly investing in businesses. As an investor in some of the world's leading businesses, he has engaged with corporate leaders and learned what success looks like. He constantly introduces constructive challenges to inform corporate decision-making and has improved the fortunes of the companies in which he has a financial interest. He has also served as a special advisor to the UK government in matters relating to business policy. And James is also the author of a highly recommended book. So with that, James, I'd like to turn it to you for your presentation today. Please go ahead.
Thank you, John. Thanks for the very full introduction. So today's pitch is likely to be different to most others because my approach is different to most others. I often find myself reading or listening to pitches of others and thinking to myself, this is back to front, upside down thinking. So I don't know if you're familiar with Ronald Coase, the British economist and Nobel laureate, but he once said that if you torture the data for long enough, it will confess to anything. And that kind of just about sums up what I'm trying to say. The issue is that we live in a world full of quants, and they tend to torture data to death with DCF models, capital asset pricing models, calculating WACC, and all sorts of other nonsense, but paying very little regard to qualitative aspects of the business. So I do the opposite, which I believe gives me an edge. And if an investment has the attributes that I look for, then I formulate an investment hypothesis in my mind and then move on to the data as a secondary level to see if it supports my thesis. And only if it does, will I invest. So kind of moving on to today's pitch without further ado, a subscriber of my Substack reached out to me and said that he'd recently read my book, Fabric of Success, and he thought that he'd stumbled across a hidden gem of a business that met most of my investment criteria. Now, incidentally, this is exactly what motivated me to write the book. It provides what Charlie Munger used to refer to as a series of mental models that help to identify great investment opportunities. So, essentially it pulls on the golden threads that run through the tapestry of every successful business. And by recognizing these golden threads, it becomes possible to spot them in other companies, which is generally the basis on which I invest. So this subscriber of my Substack thought that it spotted a largely unknown business, which demonstrated most of these golden threads. And so when he reached out to me, it piqued my interest, appearing to be a small but high quality business with an impressive management team, a market leading position and favorable growth prospects. And the deeper I went, the better it looked. So here today, I'll share it with you. And the company is Haivision. It's a Canadian company. So let me give you an overview of the company. So it was established in 2004 and it's still led by its founder 2 decades later. It's grown its top line revenue at nearly 23% CAGR for the 16 years until its IPO in 2020. And get this, all of that growth was achieved from the initial $8 million investment with no further funding being required until the recent IPO. And we all love capital light businesses because they're far easier to scale. And so, that certainly ticked one of my boxes. Now, the IPO capital raise in 2020 was needed for strategic acquisitions and to invest in organic growth. Opportunities started to unfold, and the CEO recognized that if he wanted to grow quickly, he would need more capital at that point. So that IPO marks what I consider to be a very pivotal moment for accelerated growth for Haivision. Now, it's also worthy of note that the IPO was 2020, as I mentioned, which was a challenging year in any event because of COVID and all the rest of it. But since the IPO, revenue is up 62%, but the share price is down 48%. Now, you may be thinking to yourself, okay, the company was obviously hugely overpriced and it's corrected, but you'd be wrong. The company is poorly understood. It's got low analyst coverage. Only 4 small wealth management firms cover it, and none of the big Wall Street names. And the reason for the sell-off is easily explained, and it's at the heart of the investment opportunity. So, let's look under the hood. Before we dig into the business itself, my mantra on investing is always that the management is the most important part of the thesis. The same company with different management is no longer the same company in my view. So, just think about Apple under John Sculley and Steve Jobs. Think about IBM under Thomas Watson and then Lou Gerstner. Or Intel, which was led by, Bob Noyce, Andy Grove and Gordon Moore very successfully compared to the tenure of Brian Krzanich. So you can see, same company, completely different fortune because of the person steering the ship. So if you have a great business with poor management, it's the reputation of the management that prevails. So, back to the company we're focused on here, Haivision. The founder and CEO is a guy named Mirko Wicha. You see a picture of him on the screen. And he isn't new to success. He has decades of experience in senior management and sales, having started at Hewlett-Packard, and then he joined Silicon Graphics. Now, when I found that out, it immediately grabbed my attention. For anyone that doesn't know Silicon Graphics, it was a pioneer in the realm of computer-aided design, visualization, and high-performance computing. Its campus in Silicon Valley is now the Google campus. And Jim Clark, the founder of Silicon Graphics, was a Stanford University professor and an absolute genius. He arguably developed the first GPU long before NVIDIA even existed. And in 1998, it accounted for over 50% of the graphics market. It dominated in high-performance computers for applications like computer-aided design, video editing, scientific visualization. Silicon Graphics worked with Microsoft in the creation of Windows. It developed the GPUs for the Nintendo games consoles. And its technology was used in every film nominated for an Academy Award for visual effects for many, many years, including Jurassic Park, Independence Day, Terminator, Toy Story. It was Silicon Graphics that was behind that. And Jim Clark was at the helm of Silicon Graphics. In fact, Jim Clark signed up this university kid that you probably know, a guy called Mark Andreessen. And Jim Clark, together with Mark Andreessen, developed Netscape Navigator, which was the first internet browser. So why is this all relevant to the pitch today? Well, companies like Silicon Graphics excel by only signing A-list people. These are exceptional people and really high achievers. And Mirko Wicha, the CEO and founder of Haivision, is ex-Silicon Graphics. So that's why the name Silicon Graphics really grabbed my attention here. So after leaving Silicon Graphics, Mirko joined a company called Alias, which is another software company that produced high-end 3D graphic software. While he was there, he turned around their struggling European operations, and that company was later sold, you guessed it, to Silicon Graphics. So what we have here is an A-list player with experience at leading tech firms who founded Haivision, has experienced 2 decades of really strong double-digit growth, with a long-term owner mentality and a passion to take the business to the next level. And as Steve Jobs used to say, the best businesses are run by missionaries, not mercenaries. And what we have here is certainly a missionary. So these qualities are exceptionally rare, and they're exactly what I look for when investing. And in fact, Haivision's entire leadership team is high caliber. Some of them have worked together for over 15 years, and that mix of continuity, deep industry knowledge and proven success makes them a major strength for the company. And better still, this is a CEO founder with real skin in the game. He and his family own about 14% of the business, which is valued at somewhere around $20 million, which is 20 times his cash comp. So it's very significant. More particularly, he recently added to his holding, buying a large tranche of stock on the open market, which is really great to see, not expecting to be gifted stock as stock-based comp, which is all too common, unfortunately. Insiders at Haivision collectively hold just over 31% of the equity. So there's really good alignment here of interests with internal management and external investors. So what's the business? What does it do? It offers a suite of highly integrated hardware, software, and cloud services that allow customers to ingest, process, and share high-quality, real-time video content securely to any device, anywhere. What does that mean? Well, think about this. You've got the government or Homeland Security and the military. They're increasingly using real-time video imaging, maybe personnel wearing body cameras, or drones, or other kind of surveillance infrastructure. Now, these are mission critical, and they need to get real-time images with no latency. Haivision does that. Haivision does that. Sorry. Now think about video walls being used to monitor traffic flows on highways, or for security around airports or sports stadia or shopping malls. Haivision does that too. And now think about live news reports being broadcast 24 hours a day, and the demand for watching live sports events. Again, latency can't happen. This has to be reliable. It has to be dependent. Haivision does that too. Now think about video gaming championship. So a great example is Riot Games, League of Legends. It has an annual tournament which connects stadiums worldwide and streams to over 100 million viewers globally in real time. Haivision manages all that too. Think about NASA. It captures video from cameras across its launch sites. Perhaps from Cape Canaveral in Florida, delivers those in real time to the control center in Houston. Again, mission critical data. Haivision does all of that. Haivision also delivers low latency video to the New York Stock Exchange trading floor, and to offices in across the US and in London. So this is a business with a diverse client base, a diverse offering, and mission critical, very, very important service that it offers. So customers, there are only a small number of examples that I've got for you of the value that Haivision delivers, but it works with so many companies that you'll know well. Microsoft, Meta, Apple, Disney, the chemicals company Merck, Raytheon, Boeing, Tesla, BMW, ESPN, HBO, the NFL, the NBA, the NHL, Warner Brothers, Sony Pictures, all other global news and sports networks, the military of the US, UK, Canada, and Japan, just to name a few. So it gives you an idea of how diversified the client base of this company is. Not only is it well diversified across industry sectors, but it has no customer concentration, which is really important. Customer concentration risk can often sink a ship, but this company has so many large customers that that's just not an issue. Streaming news, entertainment, and live sports are booming, but there's a long road ahead before it completely displaces satellite and cable delivery. And best of all, streamed media is delivered at a much lower cost than the traditional means of video broadcasting, explaining one of its many benefits. So moving on to the segments of this business and the market as a whole. So Haivision has carved out its place as a leader in this fast-growing market while continuing to diversify across multiple segments we've discussed. And according to independent research from Nesta, the global video infrastructure market is likely to grow at about 18% CAGR for the next decade. And streaming is claiming more and more market share over time from satellite and cable. And Haivision aspires to be the market leader in this high value segment of the market, which it estimates to be worth about 15 billion by 2033. So Haivision's revenue is mainly hardware driven, with about 80% coming from products like video encoders, decoders, transcoders, transmitters. And these tools compress, transmit video using the secure, reliable transport protocol, the SRT protocol. That's important, but we'll come back to that. More on that in a little bit. So 80% comes from hardware. The remaining 20% comes from service and maintenance contracts and software offerings. But Haivision aims to grow this high margin segment with recurring revenues as part of its long-term strategy, which bodes really well for margin expansion. So let's come back now to the SRT protocol. So the Secure Reliable Transport Protocol, SRT for short, is designed to deliver high quality, low latency video and audio streams over largely unpredictable and unreliable networks, such as public internet. The data is sent fully encrypted to ensure security. And today there's an SRT alliance with over 600 members, including names like YouTube, Microsoft, Sony, Google, AWS, and many more, all using the SRT protocol. Even Chinese companies such as Tencent and Alibaba are on board with the SRT alliance. Now, guess who developed SRT? Yeah, you got it, it's Haivision. They wrote the software, they wrote the protocol. In fact, Haivision even won an Emmy Award for this groundbreaking technology. So in a bold move, Haivision management decided to open source the SRT code in 2017, betting that the wider adoption and faster development would follow, and it worked like a charm. It's now the most widely adopted video protocol in use today, and it's become the de facto industry standard. And Haivision is at the center of it, having written the code. So even though SRT is now open source, Haivision still leads the pack in this industry. And as the driving force behind the SRT Alliance, it stays closer to the protocol's evolution than anyone else, which allows it to integrate updates into its products faster than any of its competitors. And while its products aren't the cheapest, they're often compared to the iPhone in their segment. It's premium quality worth paying for. And it certainly seems to have great pricing power. So it maintains gross margins north of 70%. And in fact, it was able to raise prices by 10% in 2022 to offset the really high inflation that we experienced and the additional supply chain costs. So that gives you an idea of its pricing power. So, how does a hardware-centric business manage to run a capital-light business model? And the answer is simple. It outsources manufacturing to select partners in the US, Canada, and France, meaning that its own CapEx investment is really minimal. And this enables the company to heavily invest in R&D to stay at the forefront of innovation and deliver cutting-edge solutions to its customers. And this combination of innovation, premium quality, and operational efficiency positions Haivision perfectly in this high growth market segment. So the pivotal moment, I mentioned earlier, the IPO was that pivotal moment where it needed to raise the capital for the first time in its history. It was 16 years old at that stage. And it's enabled the company to strengthen its positions in key areas like command centers, AI-driven intelligence, surveillance and reconnaissance, and interestingly, the 5G mobile market. So the CEO has a proven track record of successfully integrating acquisitions, having executed well on 8 since Haivision's inception back in 2004. And the impact of these moves is expected to become more visible by the second half of 2025, setting the stage for accelerated growth. So since the IPO, it's made 2 additional acquisitions. One is a company called Cinemassive, and the other one is called Aviwest. Now, Cinemassive is now rebranded as Haivision Mission Critical Systems, or MCS for short, and it allows seamless management of content across rooms, displays, and applications. And combined with its existing capabilities, the company aims to expand its footprint internationally and in its first responder and public safety markets. And as I say, the full benefits of this are expected to become evident in the figures by the second half of 2025. So MCS recently secured a massive 5-year production agreement with the US Navy, valued at around 82 million Canadian dollars. So what's that, about 61 million US dollars. And this builds on its existing relationship with the Navy, where Haivision's encoding playback tech plays a really crucial role in ship-wide video distribution. Now, the integration of Cinemassive, or MCS as it's now called, has been a game changer, particularly in its Command 360 visualization platform, which strengthens Haivision's defense applications. So Haivision is now at the forefront of combat visualization and situational awareness solutions, which are critical for mission planning and real-time decision making. The second acquisition added wireless internet protocol-based video capabilities, which complements all of its current wired solutions, which enhances Haivision's position as a comprehensive provider in the video transmission space. So in addition to these acquisitions, Haivision has also embarked on 2 strategic partnerships to drive innovation and product offerings. The first of these is a joint venture with a company called Shield AI. And the idea is to integrate Shield's technology with Kraken's, to integrate its Kraken video processing platform with Shield AI's Kestrel object detection solution. And this collaboration enhances situational awareness for defense customers, allowing for faster life-saving decisions by automating object detection and tracking in video feeds. So, I mean, that might sound a little bit confusing. I actually wrote this up on my Substack, and within that Substack post, there are a number of videos which demonstrate this technology working in action. So if you wanted to follow up, please visit the Substack and take a look at those videos in the write-up. The other initiative, the other strategic partnership that Haivision has entered into recently, is something called the Air 5G Consortium. Now, this project is deemed an IPCEI, or breaking the acronym out, an important project for common European interest. It's managed by Airbus, and it positions Haivision as a key player in next generation 5G technology, with first products expected in fiscal 2025. So once again, we're going to see the fruits of this strategy coming through in the near future. So participation, because this is an IPCEI, it's an important project for common European interest, it qualifies for European research and development grants and favourably priced development loans, which all works in Haivision's favour. So cellular bonded private 5G networks are particularly exciting, and they're expected to be a significant driver of revenue in 2026 and beyond. And Haivision has positioned itself here to be at the forefront of that technology evolution. So the IPO and these subsequent strategic moves have set Haivision up for long-term success, with top-line growth poised to accelerate as its innovations and partnerships bear fruit over 2025, 2026 and beyond. So other strategic initiatives. So it isn't all about building and acquiring. In addition to watering the flowers among its subsidiaries, Haivision pursues a strategy of cutting the weeds. And it isn't afraid to cut underperforming segments within its business. In April 2023, the company made a bold move to exit its lower margin managed services business, including something called the House of Worship market, which provided video streaming solutions for churches and ministries. So the reason for this was that streaming religious services has really low barriers to entry because performance and latency and security are far less important. So it's becoming kind of a commoditized service and very unattractive on that basis. So exiting the segment was the correct thing to do. However, it led to a short-term dip in cloud solutions revenue for Haivision. Because they cut it dead literally, overnight, because it allowed the company to focus on delivering more specialist mission critical solutions that align with its core competence and which attract less competition and are more profitable at higher margins. So the company's also stepped away from offering bespoke solutions that relied heavily on supplying third-party components to its customers. And Haivision has pivoted from being a systems integrator to a manufacturer in the control room space. So previously, Haivision's integrator approach meant bundling third-party components, which included displays, cables, mounts, with its own products, which added complexity and delays and bloated inventories. So it wasn't great for the business. But now Haivision's channel partners handle all of that third-party component business, which is a new source of revenue for them, which they welcome very much. And by ditching these lower margin, labor intensive operations, Haivision has simplified its business model and boosted its gross margins and doubled down on its proprietary high value solutions. So it's very much kind of a win-win for everybody concerned here. Another strategic move was launching a rental program for its transmitter products after acquiring Aviwest. So this initiative enables customers to recognize an ongoing operating expense rather than a large upfront capital expense, which makes it far more attractive as a proposition for many people who are interested in Haivision's commodities. It effectively opens the market to a wider customer base. And it also keeps customers future-proofed. As you know, if they rent the equipment, they can easily upgrade to the latest technology during the rental term, which they quite like. So customers now have maximum flexibility, choosing to buy equipment outright, rent it for individual events, perhaps the Olympics or the FIFA World Cup, or opting for a long-term rental contract. So there's a full menu of options. They also have the option of accessing software via cloud subscriptions or on a pay-as-you-go basis. So there really is something for everyone. And this move delivers clear benefits as it increases recurring revenue, increases the margin earned on each product over its lifespan, and it makes sales easier to close. And all these changes, exiting non-core markets, streamlining operations, transitioning to manufacturing, rolling out rental programs, they're all part of a broader strategy to enhance profitability, grow recurring revenue, and solidify the company's leadership position in mission-critical video networking and visual collaboration. So let's look at the financials and valuation. So this dynamic decision-making showcases a forward-thinking management team focused on long-term success, which is certainly most welcome from an investment point of view. All the recent strategic shifts, the acquisitions, partnerships, streamlining operations, promise higher margins and scalability, which will become evident from the second half of 2025 onwards. However, in the short term, earnings have been negatively impacted by the phasing out of the lower margin revenue streams, which it felt immediately. So we're in kind of a transition period at the moment where the increase in high margin business hasn't yet come through, and the lower margin business was cut entirely. So there's kind of a bit of a lag in the kind of earnings profile. So the share price has taken a hit as a result. But it's a classic case of short-term pain for long-term gain, and the future looks incredibly bright. So gross margins are climbing towards 75%, which is absolutely incredible, driven by the increased adoption of software-only and virtual machine deployments, which have fixed costs and they scale really well with higher revenue. So in terms of operating leverage, OPEX as a percentage of gross profit has dropped over 1,000 basis points in the past 6 years, and that trend is continuing. So the good news is, gross margins are really high at 75%, and the operating margins are going to increase. They're gradually going to be pulled towards those gross margins. So a 14% reduction in headcount and the disappearance of non-recurring extraordinary expenses, largely the strategic restructuring costs and professional fees, have been contributing to cost savings as time goes on and as we move away from those recent acquisitions. So there have also been decreases in amortization and depreciation expenses and savings made in technology and communication costs as the operations become more efficient. And as mentioned earlier, the breakdown of this business is currently 80% hardware, 20% higher margin software and cloud services. But this ratio is shifting as the company targets more of the higher margin business. So as these ratios shift, profit margins are likely to expand even further. Now, Haivision's balance sheet is in great shape. It's got a net cash position of about $14 million. That was as at the third quarter of 2024, compared to just $1.7 million in long-term debt, almost nothing. The company also has access to $35 million revolving credit facility, which is expandable to $60 million if it wishes to expand on an accordion type basis. of which only 3.4 million has been used to date. So this kind of financial flexibility certainly supports the continued growth of the business. Now, at a share price of, when I broke the company up, it was trading at $5.15. Today, I think it's $5.40, so it's crept up very slightly. But the market cap is around about $145, $150 million, with an enterprise value of just under that. They're very similar, but with a net cash position, the enterprise value is slightly lower than the market cap. So for 2025, the company is guiding over 140 million in revenue, with adjusted EBITDA margins expected to improve by 100 to 200 basis points. And this means that Haivision is currently trading at just 1 times next year's sales, which is an absolute bargain considering its forecast 20% EBITDA margins, double-digit revenue growth over the next few years, 75% gross margins. And so a re-rating looks almost inevitable as the market wakes up to this opportunity. But as I say, it's got very, very low analyst coverage at the moment. So what does the competition look like? So there are a number of companies who operate in the same segment that are worth a mention. Let me just kind of run through what they are, who they are. So the first one is Wowzer Media Systems, which is a big player in live streaming. It's got over 60,000 clients. It offers an affordable and a pretty solid streaming engine, but it lacks the advanced features that Haivision offers, and so it has a much narrower focus compared to Haivision. Now, interestingly, Wowzer and Haivision seem to share some customers, or they claim to have the same customers, which raises some questions. Is this about redundancy strategies where the same company has contracts with 2 different businesses to ensure resilience against failures and minimizing downtime? Or are these customers transitioning from one provider to another? I've tried to find an answer to that question, and so far I haven't been able to answer the question, but so something to bear in mind. Telestream is the next company worth mentioning. This is privately owned. It's grown steadily, primarily through acquisition. The tools that it offers are very scalable. It can handle anything from small events to massive global broadcasts. But their tools, one of which is called Wirecast, can be really complex, and there's a really steep learning curve. And while their pricing is flexible, it can get really expensive if you want the fancy stuff that they offer. So the other thing worth mentioning about Telestream is that they have a new CEO who took over in 2023. And this really sets it apart from Haivision in my mind. Metaphorically, I prefer to invest in Michelangelo with a vision and passion to create a masterpiece that's the Sistine Chapel, rather than someone who's subsequently employed simply to maintain what someone else created before them. And as I said earlier, Haivision is founder-led compared to Telestream, which has had a new CEO in place only for a year. And as far as I'm concerned, every time a new CEO comes into a company, an investor really rolls the dice. You never know, how that's going to go. It may go well, it may not, but certainly a risk. Akamai Technologies are the next one worth mentioning. This was founded by an ex-MIT professor. And, it's certainly a market leader in the industry. It's all about internet connectivity. Its massive, high definition network delivers high quality video streaming worldwide, but it can be complex to implement and costly. Interestingly, Akamai currently trades at 4 times sales. And as I mentioned earlier, Haivision is only trading at 1 time sales. So that gives you an idea of kind of like for like comparisons. The other thing is that Haivision is still valued as a small cap company, almost a micro cap company. Its market cap is currently around $150 million, whereas Akamai is valued at just over 14 billion. So, that also opens up another possibility. There's a real chance someone like Akamai may come in to acquire Haivision at some point in the not too distant future, particularly given the multiple differential. Brightcove, now this is an interesting one. This is highly rated by smaller or medium-sized users for its user-friendly feature-packed platform, and it operates across 70 countries and specializes in video management. But its pricing isn't great for companies with lots of content, so it's not exactly in the same kind of Haivision league. It partnered with Akamai for smoother video delivery, so it needed that partnership in order to deliver the kind of service that Haivision delivers alone. But it struggled for many years with profitability and really slow revenue growth. So again, that kind of points to mediocre management, especially given all that Haivision has achieved. So ultimately, Bright Cove was acquired very recently by the Italian tech company called Bending Spoons, which is best known for mobile apps, but it's recently taken Bright Cove private. So it kind of gives you an idea also that there is appetite here for acquisitions and consolidation, which is another reason I think someone like Akamai or perhaps another PE type business might come in at some point for Haivision, given its current valuation. Finally, the other key player in this area is IBM, which offers really powerful enterprise-level video platforms with features like AI-powered closed captioning and video search through its IBM Watson AI. And its recent Red Hat acquisition has strengthened its hybrid cloud capabilities, which bolster the service it's able to offer to those with really complex streaming needs. However, IBM video streaming generally receives lower user ratings than both Bright Cove and Haivision, and it's not particularly cost effective. So I don't think it's a particular threat for Haivision. So despite all this competition, Haivision really stands out. They've got diverse revenue streams. They're leaning into a high margin recurring revenue stream. They dominate in the government and defence markets, plus their cutting edge tech is certainly ahead of the competition. They've got the SRT protocol, which they developed, which is now an industry standard. They're run by an innovative founder-led management. They've got excellent customer services, and it really sets them apart from the competition. Additionally, 3 out of the 6 featured businesses that we've discussed, including Haivision, are private businesses. The IBM offering is a segment within the broader group, and so it's not a pure play in streaming. So if you wanted to invest in this kind of streaming growth, then that only leaves Akamai, which is capitalized to more than 4 times sales, and Haivision available to public investors. Wrapping it all up, Haivision is a compelling blend of innovation, strategy, and execution. Its leadership, diversified revenue streams, focus on high growth, positions it for sustained success. This is a small cap business that's punching well above its weight and not likely to remain a small cap for very long. It's an incredibly sticky business. Its customers rely really heavily on its products and solutions. They're designed with a focus on reliability, and they're at the cutting edge of available technology. And they address the critical needs of the users, which is most important. They offer an exceptional customer support and maintenance commitment, and there's simply no incentive for customers to switch. So these strategic acquisitions and partnerships we mentioned earlier are complementary to the current in-house product development that flow from the continual investment in R&D, because it has very, very low capex. Again, we spoke about that earlier, all of which creates a competitive advantage for Haivision. Haivision's highly scalable solutions allow customers to expand their video streaming capabilities seamlessly as required. And this translates into high recurring revenues and robust organic growth before any new customers are added into the mix, and it's always adding new customers. So in an industry forecast to grow at 80% a year for the next decade, it appears that Haivision ought to be able to capture high double-digit top-line growth in the years ahead. And as a point of reference, over the past 5 years, it grew its top line at an annualized 19.3%. Despite huge disruptions caused by COVID-19, regional wars, high inflation, a jump in borrowing costs, a shortage of semiconductors, plus manufacturing and shipping disruptions, it still grew at 19.3%. And that's likely to continue. So double-digit revenue growth seems entirely achievable, and in combination with the company's exceptional gross margins and favourable operating leverage, points to expanding profit margins and strong earnings power in the years ahead. But that's not all. So in January 2024, Haivision received approval to repurchase up to just over 2 million shares over a 12-month period, which is about 10% of its float, of its public float. And it has a normal course issuer bid in place. By July 2024, the company had already purchased 462,000 shares at an average price of $4.33. It spent just under 2 million Canadian dollars doing that. During its Q3 2024 earnings call, management also indicated a strong likelihood of renewing the program, citing confidence that the stock's current undervaluation simply doesn't reflect the true value of the business. And they intend to keep buybacks rolling. So, Haivision has recently implemented an automatic share purchase plan, ensuring that it can still repurchase shares during blackout periods. So that gives you kind of an idea of how committed they are to these buybacks. So, there are 4 key drivers of shareholder returns. There's revenue growth, there's margin expansion, there's multiple expansion, and a reduced share count. And all of those look likely to improve. And when these factors combine, the multiplier effect should significantly reward investors in the years ahead. So even with conservative assumptions, the potential upside is quite eye-watering. So if we assume Haivision grows revenue at only 11%, so bear in mind the last 5 years has been over 19%, and the industry is expected to grow at 18% as the market leader. But let's just assume conservatively 11% top line growth. Let's assume it only reduces its share count by 2% annually, and it improves its margins by 400 basis points, and its earnings multiple expands to about 18 times, which certainly isn't excessive. That kind of scenario would deliver a total return of 302% over the next 5 years, let's say, or 32% annualized. Discounting that back at a 10% discount rate suggests the stock could trade at close to $13 a share at the moment, relative to its current share price of $5.40. And remember, these are relatively conservative assumptions. So this is a company that's hugely undervalued. So at a valuation near parity with revenue, Haivision's current price doesn't reflect its robust business model, its impressive margins, and its growth potential. So for investors, this could be a really rare opportunity to buy into a high quality, high margin compounder with plenty of room to grow.
Now that we've heard the investment thesis, let's hear from the CEO, Mirko Wicha himself. He is able to explain the business and its origins better than anyone.
The power of real-time live video struck the world about 50 years ago when America actually landed on the moon. Now, since then, the technological progress of network connectivity from the first TV broadcast to the internet, and more recently mobile, have transformed the world for consumers, enterprises, and governments. Beyond the ability to instantaneously share text, emails, documents, pictures, and data of all types, everyone now relies on real-time live video to ingest information, process it, to drive decisions, and then share the outcome. And this is the ultimate power made possible by 50 years of network video and data processing innovations. Now, we are now at a tipping point, right, with the prevalence of cloud computing, the emergence of 5G, advancements in AI, ubiquitous bandwidth and unlimited data processing is now a reality. Now, combine that with the complexity of real-time video. What was once considered a novelty has now become a necessity. Now, we call this transformational wave, the real-time video revolution, and Haivision aims to lead it in the enterprise, the government, and the defense markets. Now, Haivision's mission is to drive awareness, better decisions, and faster responses by leveraging real-time video across fixed and mobile networks through performance, quality, reliability, and security. That's the DNA of all our solutions. The use cases we serve are varied, yet our solutions are all based around the same 3 steps. We first ingest the video and data source generated from cameras or sensors to carry it across a network. We then process it to match market-specific needs and create value, and then we share it to downstream users or exploitation systems. Now, whether it's a director in a bustling environment of a live NFL game, commander stationed in the strategic confines of a war room, or a CIO orchestrating response to a cybersecurity attack. I mean, Haivision empowers them to observe and engage with the world in real time with unparalleled clarity and precision, or as we like to call it, the mission-critical video networking. Our ability to serve truly diverse customers needs with the same set of solutions is a unique differentiator, allowing Haivision to create value from a truly global market opportunity. And let me be a little more specific with a few customer examples. And within the context of controlling, optimizing, and protecting the global enterprise, Haivision leads the market in providing real-time video and visualization solutions. We cater to professionals within organizations that require real-time video and information to effectively do their jobs. From delivering live video to financial traders, like we do for RBC, Citibank, New York Stock Exchange, to network operations centers such as Akamai, Salesforce, Meta. Our solutions play a pivotal role in decision-making, resource allocation, and strategic planning, particularly in emergency or complex operations. And installations such as these demand the highest level of system security and 24/7 resilient operational capability, together with high-end performance, responsiveness, and connectivity. Now, cybercrime has also become a serious concern, and enterprises are increasingly adopting military command center style approaches to their cybersecurity strategies. And this involves establishing centralized, highly sophisticated video operation centers that are designed to monitor, assess, and respond in real time to global cyber threats across the entire enterprise. Now, for example, Meta has turned to Haivision to help in visualizing virtually every aspect of their business, including cybersecurity, network operations, fraud, physical security, and critical data center systems. In fact, they have commissioned over 60 operational centers globally, all connected back to their 3 major GSOCs, which is Global Security Operations Centers. Haivision has also invested significantly in security, certifications, and network threat compliances, thus creating a huge barrier to entry. In government and defense, where security, performance, reliability, and low latency are paramount, we specifically focus on several things: mission-critical video distribution across government campuses and offices, within space centers, and onboard military or defense platforms. Global ISR deployments. ISR stands for Intelligence, Surveillance, Reconnaissance. This includes the critical video from sensors and cameras and drones that pilots on the other side of the world rely on. And command centers, from real-time crime centers for police departments to joint operations centers that enable coordinated military action. In fact, NASA, one of our strategic accounts, relies on Haivision to capture video from all their cameras all over their launch sites, deliver those critical feeds throughout their campuses, and display the video along with other mission-critical data within all their mission control centers. Now, Haivision has been a game changer in the media and entertainment industry, pushing the boundaries with innovative, ultra-low latency video network technology for almost 20 years. I mean, back in 2010, we first teamed up with the NFL to transform live remote interviews. Then in 2014, we invented and introduced our groundbreaking streaming protocol for secure, reliable transport, now known as SRT, offering a cost-effective alternative to expensive satellite or expensive MPLS feeds, spreading our technology to every cloud video broadcast and streaming professional. And then in 2017, we took the bold step to open source SRT, transforming the entire industry. Private 5G networks and the advanced application of 5G network slicing is unleashing vast new broadcast production opportunities. We invested in this wireless sector by bringing the latest 5G bonded cellular technology to our premier customer list. We demonstrated the power of this technology through the coverage of the King's coronation last summer and at the Winter Olympics of last year. Another one of our large clients, ESPN, is leveraging our technology in a massive way. For NCAA sports, over 600 college venues are wired up to stream live events straight back to ESPN's control center in Bristol, Connecticut. In fact, our Makitos and SRT technology power through a staggering 2,500 events each year for their OTT platforms. Now, this Haivision powered network contributes to more than 10% of ESPN's 23,000 live events annually. From CNN's newsrooms to the Olympics, Haivision's presence and broadcast is undeniable and everywhere. We're not just part of the scene, we're at its very, very core. Now, as our customers' examples demonstrate, Haivision's focus on live video use cases applied to market segments where our DNA of performance, quality, reliability, and security are most important. We don't play in the consumer market or the low-cost prosumer video market segment, which investors rightfully perceive as low value. Nor do we play in the video conferencing market, competing with Zoom, Skype, or free offerings like Teams. Now, mission-critical video networking represents the highest value segment of the global video streaming infrastructure market, estimated to be about $23 billion back in 2022, and to grow at a compound annual growth rate of about 16% over the next 10 years. Now, out of the $23 billion TAM, we estimate our targeted high-value segments were about $5 billion in 2022. Now, live video represents the lion's share of this market, and it always starts at the back of a camera or sensor. Our strategy is focused on three high-value segments: enterprise, government and defense, media and entertainment. Leveraging our end-to-end solutions across market segments is foundational to our business as we maximize technical synergies and credibility while differentiating against pure play players. Now, we serve a broad set of customers and markets, and it all starts with the ingest stage where the video output of the camera or sensor needs to be encoded and sent over a network. And we address this challenge with two award-winning families of high-value hardware solutions: our Makito, designed for fixed networks, and our Pro Series transmitters, designed for mobile wireless networks. The barrier to entry for solutions matching our DNA is high, and we demonstrate the significant value we bring to these solutions with gross margins in excess of 70%. We also offer pure software solutions tailored to the needs of each market and representing the majority of our R&D investments. Note that systems in government, defense, and enterprise are often on-premise solutions due to their mission-critical nature and security requirements. And our software solutions are also available within public clouds, and our growth strategy includes continued development of SaaS solutions with recurring revenue streams. In addition, we support all of our hardware and software solutions with recurring maintenance and support revenue. Finally, artificial intelligence and machine learning are also used across our product portfolio. I mean, at the time of the ingest to enhance the incoming video with real-time intelligence, and at the process stage to optimize the efficiency of our solutions, and at the share stage to optimize the quality of the video output. Now, when it comes to transporting live video over any network, Haivision is absolutely the world leader in innovation and technology. 20 years ago, Haivision brought to the market the world's first ultra-low latency codecs that were the foundation of the telepresence, distance education, and telemedicine markets. In fact, the SRT protocol we invented 10 years ago continues to be Haivision's strategic cornerstone within the global video market. SRT actually has established Haivision as a true pioneer that created a revolution, opened the doors to the highest level of leadership within our clients, and forged the path to many strategic partnerships and M&A opportunities. We have also established Haivision as being on the cutting edge of ultra-low latency 5G innovation. Anchored by client, equipment vendor, and telco partnerships, we have pushed the envelope of live video over cellular networks. Haivision continues to outpace the competition in innovation. Finally, for our collaboration with the major players in public cloud and AI, we are looking to make high-performance live video not only simple and ubiquitous, but intelligent in what specific video needs to be delivered, what information is captured and created to accompany that video, and how efficiently that video gets delivered from source to destination. So about the DNA. Like when I founded Haivision almost 20 years ago, we defined our market focus back then as live video for applications that require ultra-low latency encoding under low bandwidth conditions. The past 5 to 7 years has seen an explosion in demand for live low latency HD video using the public internet. And interestingly enough, the overall video market has now moved into our domain of expertise. We have also steered away from applications that don't require our core values, and we definitely do not play in the consumer space, right? We focus on clients that align with our fundamentals, where we can provide the highest differentiated value. Clients come to Haivision because of our core DNA fundamentals and technological leadership. We solve the fundamental needs of our clients through a consultative approach. We do this through a global sales organization equipped with top field engineers in the business. And many of our clients continue to buy from us for years. In fact, about 75% of sales last year came from the clients that purchased from us the previous year. This really shows predictability and a sense of recurring revenue we enjoy. In fact, we also continue to build multi-year deployments for large programmatic business with clients that deploy our solutions over multiple years. And a few great examples are the US State Department, upgrading all their 183 plus embassies worldwide over 5+ years, or the US Navy, where we continue to upgrade their video systems for the past 7 years, or the US Department of Defense, the Predator program that we retrofitted 3 times over a 10-year period. Now, with that overview, let's look at the Haivision numbers. Now, today we have approximately 350 employees throughout the world and 140 million in revenue in our fiscal year 2023. Since our incorporation in 2004, we have delivered 17 years of positive adjusted EBITDA, which we see as a proof point of the value of our vision. Our strong 70% plus gross margin profile is another testament to our innovative technology and to the solutions we provide for these mission critical and high demanding use cases. Now, as mentioned earlier, we target the $5 billion high value segment of the broad video infrastructure market, which is a total TAM of about 23 billion. We believe this is the right segment with significant growth perspective to deliver long-term shareholder value. Also, over our history, we've done 8 acquisitions to serve our growth objectives, and we will continue doing M&A as opportunities arise. I would say that today, Haivision is seen as an innovator, disruptor, prime influencer, and technology leader in the real-time video industry. Now, profitable growth has been a guiding principle since I founded Haivision. In our 16+ years as a private company, we grew organically at 22.7% CAGR and have been excellent stewards of capital. As from an initial investment of only 8.25 million in capital, we delivered over 80 million in revenue at the time of our IPO in 2020. Not sure many companies can actually say that. Usually it's the reverse, right? They raise 80 million, maybe they have sales of 8 million. More importantly, the current market conditions show us how critical it is to keep profitable growth as a core objective of the business to drive long-term shareholder value. Now, our acquisitions history also included 2 strategic post-IPO acquisitions to position us as leaders in the command centers and 5G wireless development, an essential part of our vision for the real-time video revolution. Now, considering that 80% of acquisitions fail, we have an impressive record of accomplishment, and we will keep leveraging our team's expertise in strategic M&A to expand product offering and grow revenue. Our growth will be driven by the demand for increasingly complex command centers across all market segments, expanding the reach of those command centers to the rest of the world, introducing AI to our products to make them more intelligent, and by new possibilities offered by 5G connectivity in the media and entertainment domain. We have built a sizable business, and the investments we have already made in product development and in our sales organization are enabling us to drive operational efficiencies and accelerate profitability faster than revenue growth. And this is just the beginning. Haivision has the potential to serve as a platform for growth and reap the benefits of the real-time video revolution. Talk about people. Our management team has an average of 30+ years in the video industry, and most of us have worked together for the last 15 years. In fact, I've worked with Peter, our Chief Strategy Officer, in my previous life at Discreet and Autodesk, and since the very beginning of Haivision. Dan, our CFO, joined us in the early days of Haivision as well. In addition to that, a year ago, we successfully strengthened our product activities with the arrival of Jean-Marc as our Chief Product Officer, who ran all product strategy at Cinemedia. Now, this team is tight and works extremely well together and with all the other senior management of Haivision. And our ability to deliver also relies on the engagement and quality of our employees. We are proud to have assembled a diverse workforce spread across 24 countries, 17 time zones, and speaking 27 plus languages. And we're also proud to say that 50% of our employees have been with us for more than 5 years. The right balance to retain expertise while allowing ongoing acquisition of new talents. It's all about people, and our culture is dear to my heart. It's what built Haivision and makes us special.
So that kind of brings an end to the pitch. Just the standard disclaimer and disclosure. I do have a position in Haivision, and this presentation is for informational purposes only, shouldn't be construed as investment advice. And while best endeavours have been taken in the compilation of information contained in the presentation, there's no warranty, express or implied, offered in relation to the completeness and accuracy of the information. So please do conduct your own due diligence, and if necessary, seek professional investment advice before making any investment decisions. And that's me. That brings an end to the presentation.
Wonderful. Well, thank you so much, James, for this compelling investment thesis. Maybe we could just start with the recent growth. I believe the company has not seen the kind of historical growth in the latest quarterly period. Could you just talk about that a little bit more?
Yeah, I mean, that I kind of touched on it earlier a little. So the company is currently in a transition phase at the moment. So it IPO'd, it raised capital, it made a couple of acquisitions. Those acquisitions are likely to deliver more high margin business, but that won't be evident in the numbers until probably the second half of 2025 and beyond. Meanwhile, it cut back on some of its lower revenue business. So it cut back on the House of Worship business, which was the streaming of church services and the like, and also the supplying of third-party components. The monitors, the cables, the frameworks to mount all of the monitors and that type of thing. It was all low margin, required them to carry high inventories. They cut all that back, and so the problem we have at the moment in this transition phase is that even though it was low margin business, it was bringing in revenue, it was bringing in earnings, but they cut that dead in order to focus on the new acquisitions and the new higher margin business, which won't start to show through until probably the second half of this year. And so at the moment, we're in this kind of dip. But as I said earlier, it's very much short-term pain for long-term gain. However, the market price, the share price is down about 48% since the IPO. And the reason for it is that the market tends to be very myopic and short-term focused. So, they're looking at quarterly numbers, and yeah, the quarterly numbers have dipped, but for good reason. Most of the market haven't taken the time to understand why the numbers have dipped. So the share price is off heavily, despite top line growth of over 60% since the IPO, and that creates a fantastic opportunity, I think, to get on board with this company. But hopefully, John, that answers your question. That explains why the short-term numbers are down, but it's all for very, very good reason. And the better numbers are going to start showing through in the second half of this year.
That's very helpful. Thank you. And in terms of the share repurchase program, are we already seeing some meaningful buyback activity, or is it just an authorization at the moment?
No. So the authorization was given in January of 2024, so a year ago exactly. By July, about 6 months later, the company had already repurchased 462,000 shares. And it's put in place this automated share purchase plan to continue buying through the blackout periods. Now, bear in mind, the average price of the repurchases back in July, we don't know what it's repurchased since because we're waiting for end of year numbers to be published. So it may well have completed that program. But at the time, at July last year, the average purchase price was $4.33, which is pretty much $1 lower than where the share price is now. So amongst other things, I think the share repurchases are starting to help the share price recover, and they were incredibly accretive for shareholders given the share price appreciation since. But there's still quite a long way to go. And as I say, the management is very much committed to continuing. We should hear January this year about the renewal of that share repurchase program and how many shares they anticipate buying back this year.
And so what would be the key data points to keep an eye on going forward to gauge whether the thesis is playing out and whether this resumption in growth is starting to materialize?
Well, the gross margins haven't changed very much through the company's life, but they are getting slightly stronger. They've always been kind of north of around 70%, but they're now climbing towards 75% as the company transitions to higher margin software and cloud business. So we need to keep an eye on that. The 70-75% level in any event indicates that Haivision has very strong pricing power in the market. So again, that's something to monitor to ensure that it keeps that position. While it has the strong pricing power, it's inevitably a leader in its industry. So the thing to look at is the operating margins and the EBITDA margins, if that's something you want to look at. Those have been depressed, as I discussed, by the transition period, by cutting the low margin business before the high margin business starts to flow through. And there were a number of extraordinary costs that the company incurred. It made 2 very major acquisitions. It had its IPO. And so, there were lots of transition costs, legal costs, etc. Those are all behind it now. And so what we should see is OPEX coming down and operating margins going up. And, as we transition away, but at the moment, we've got 80% hardware, 20% software, but it's intending for that ratio to adjust so that there's more and more software contribution into the numbers going forward, which should result in higher operating margins. So it's a question of monitoring those as well. So as what we're looking at is revenue growth. We're looking at gross margins maintained at the 70-75% level, and operating margins and EBITDA margins climbing sequentially, I suppose, over the course of the next 8 quarters.
And James, maybe lastly, what would be the key long-term risk to the company's business in your view?
Well, it has a number of very large competitors. IBM operates in its market. Akamai operates in its market. They're all whales compared to Haivision. And so, there's a chance, I suppose, that they might come in with some groundbreaking technology. But it's highly unlikely because Haivision is very much at the forefront of technology in this market. As I explained, they developed the software SRT protocol. They are also on the leadership team of the SRT consortium, which is more than 600 companies now. So it kind of leads the development of SRT going forward. And because it knows what's happening there, it can develop its own hardware ahead of the competition, which is great to see. Frankly, I don't really see any key dangers. If you think about who its clients are, you're looking in, you've got the military, you've got NASA, Microsoft, Riot Games. These are big companies, ESPN, the NFL. They want to make sure that video from whatever it is that they're doing is being streamed reliably without any latency and high quality, which is exactly what Haivision does. And relative to the kind of revenues that those companies earn, the fees that Haivision charge are relatively negligible. So there really is no incentive to switch. It's a very, very sticky business. Why would they switch away from something that works incredibly well? And you know, there's no upside for them. So I don't see a great deal of risk, which is, you know, one of the other things that really attracts me to this business. It seems to tick almost every box that I look for. It's got a great leader. It's got a great business model. It's a market leader. It's got great margins. It's got sticky customers. It's got great diversification across customers and revenue streams. It's in a market which is expanding. There doesn't really seem to be anything ahead, which is bad. However, you know, having said all of that, just think about the differential in the valuation of Haivision relative to its key competitor, which is Akamai. It trades at only 1x sales, whereas Akamai trades at nearly 4.5x sales. You know, so arguably there is a great margin of safety there in the current share price. You know, based on my very conservative estimates, the company is worth more than double where it's trading now. So I don't see anything that will negative. It's a very asymmetric skew in terms of risk versus reward, which is again, you know, something I look for. So as Monish Pabrai would say, you know, heads I win big, tails I don't lose very much, and that's kind of the situation you're in here.
Wonderful. Well, I will leave it there, James. I would just encourage MOI Global members to feel free to follow up with any further thoughts or questions. Thank you so much for taking the time to join us today and share this investment thesis with the MOI Global community.
If you want to explore any of the themes discussed in more detail, see the show notes or visit us at rockandturner.substack.com. Oh, one more thing. Be sure to like the episode, share it with others, and save it to your favorites so that you don't miss future episodes. Until next time, we wish you every success with your investments.